ETN AI, Power Series Episode 4 English Voiceover. Welcome back to 100 Baggers. This is the fourth company in the AI Power Series. In the first three episodes, we stayed mostly on the power supply side of the AI electricity chain. Today we move to the other side, equipment and system capability. The company is Eaton, ticker ETN. With ETN, the thing investors are buying is not electricity price leverage. It is something else. How electricity enters data centers, factories, commercial buildings, and mission-critical equipment, safely, reliably, and efficiently. ETN is not a power producer. It does not rely on capacity prices, nuclear plants, or 20-year power contracts with cloud companies. It sells the equipment, systems, and engineering capability inside the power path. Medium voltage distribution, low voltage distribution, breakers, transformers, UPS, power quality, busway, PDU, industrial and commercial electrical systems, plus the thermal management and liquid cooling capability added through Boyd. That is the core of ETN. So the real line of this episode is this. AI power is not only re-rating where electricity comes from, it is also re-rating how electricity enters the data center. ETN's opportunity is an electrical platform re-rating. Its risk is that strong orders may not all turn into high-quality cash, from ordinary industrial to power path. There are two easy mistakes when looking at ETN. The first mistake is to treat it as an ordinary old-line industrial company. In that version of the story, ETN just sells electrical equipment, aerospace components, and vehicle-related parts. The cycle comes, the stock goes up, the cycle passes, the stock comes back down. The second mistake is to treat it as a pure AI data center concept stock. You see very strong data center orders, and you immediately put it in the same valuation box as a high-purity data center infrastructure company like Vertiv. Both readings are incomplete. A more accurate definition is this. ETN is a high-quality industrial company built around an electrical platform, supported by aerospace as a quality stabilizer, and now extending deeper into data center content through Boyd. Let's first make the names clear. Electrical Americas, or EA, is ETN's North American electrical business. It is the most important growth engine right now. It serves power distribution, protection, conversion, power quality, data centers, industrial, commercial, and utility customers in North America. In simple terms, EA is ETN's core electrical platform in the U.S. and the Americas. Electrical Global, or EG, is ETN's international electrical business. Together with EA, it forms the company's electrical core. The difference is geography. EA is the North American engine. EG means ETN is not dependent only on the U.S. market. Aerospace is the aerospace business. It is not the hottest part of the AI power story, but it matters. Aerospace usually has certification barriers, long customer relationships, aftermarket revenue, and stronger margin quality. Inside ETN, it acts more like a stabilizer. Boyd is the large thermal management acquisition ETN, closed in the first quarter of 2026. Boyd makes thermal components, systems, and ruggedized solutions for end markets, such as data centers and aerospace. In plain English, Boyd adds liquid cooling, cold plates, heat exchange, and thermal capability for higher power density environments. So ETN's structure can be read this way. EA and EG are the core electrical platform. Aerospace is the quality stabilizer. Boyd is the thermal management upside. Mobility-related businesses are more like non-core assets that may gradually move out of the portfolio. ETN belongs in the AI Power Series not because it sells electricity, but because AI data centers require a full power path. Power comes in from the external grid. Then it moves through medium voltage distribution. Once it enters a campus, it needs voltage reduction, protection, and conversion. Inside the data center, it moves through UPS, power quality equipment, busway, PDUs, and breakers. And as server power density rises, thermal management and liquid cooling become part of the system. AI power is not only about power plants. From the grid to the data center, from distribution to backup power, from outage protection to thermal management, every link is becoming more important. ETN's strength is not one single product. It is that the company touches multiple critical nodes along that power path. That is why data center demand is lifting ETN's market identity, but the boundary also matters. ETN is not Vertiv. Vertiv is purer and more directly exposed to electrical power, cooling, racks, modular infrastructure, and services inside the data center room. As AI rack power rises, Vertiv's torque is more direct. ETN is broader. It serves data centers, but it also serves industrial markets, commercial buildings, utilities, aerospace, and other electrical end markets. So the advantage of ETN is stability and a wider base. The disadvantage is lower data center purity and less direct upside torque than Vertiv. More accurate reading is this. ETN is an electrical platform company whose identity is being lifted by data center, and AI power demand. Demand is strong, but margins were pressured first. ETN's first quarter numbers were strong. In Q1 2026, sales were $7.451 billion, up from $6.377 billion a year earlier, for 17% growth. Operating cash flow was $507 million versus $238 million last year. Free cash flow was $314 million versus $91 million last year. Those numbers tell us ETN is not just a story. Growth and cash flow both improved, but the most important contradiction also showed up in the same quarter. Overall segment margin fell from 23.9% to 22.7%. The key issue is Electrical Americas. EA sales were $3.6 billion, up 20%. Rolling orders grew 42%. Backlog grew 44%. Data center orders rose about 240%. That sounds extremely strong. But in the same quarter, EA margin fell from 30.0% to 25.6%. We should not read only the surface number. Management gave two main explanations for the EA margin decline. First, there was a timing gap between price and cost. Commodity costs moved up faster at the start of the year, while price increases do not immediately enter revenue on the same day. ETN implemented price increases on April 1st. Management's point is that part of the cost pressure should be offset by pricing in later quarters. Second, there were ramp costs. EA orders and backlog grew so quickly that the company pulled some investment and costs forward to serve demand. New factory ramp, labor, depreciation, and startup costs all hit the cost line first. The corresponding revenue and operating leverage do not appear all at once. So the margin decline does not necessarily mean unit economics suddenly broke. The better interpretation is that ETN is adding capacity ahead of stronger growth, and that can pressure margins in the short term. But investors should not simply accept the explanation for free. If these pressures are truly temporary, EA margin should recover over the coming quarters, ideally moving back above 30%. If revenue keeps growing quickly but margin does not come back, then the quality of this data center and electrical order cycle deserves a discount. That is the most important question for ETN now. The question is not whether demand is strong. Demand is already strong. The real question is, can demand this strong still leave behind the same high-quality profit? The previous companies in this series each had their own verification variable. For ETN, the variables are EA margin, backlog-to-cash conversion, and the capital cost of Boyd. Strong orders are good. Margin pressure is a warning. When both happen at the same time, investors cannot value the stock only by upgrading the order story. EG and Aerospace give ETN a floor. ETN is not only Electrical Americas. If it were only EA, it would look more like a North American data center and electrical order cycle stock. But ETN also has Electrical Global and Aerospace. Start with Electrical Global. In Q1 2026, EG sales were $1.945 billion, up 21%. Organic growth was 9%. Acquisitions added 6%, and currency added 6%. Margin was 19.2%, above 18.6% last year. Backlog grew 73%. The point is not that EG is stronger than EA. The point is that it makes the electrical platform more complete. EA is the North American engine. EG is the international second engine. Together, they show that ETN is not only a U.S. data center story. Then there is Aerospace. In Q1 2026, Aerospace sales were $1.139 billion, up 16%. Margin was 26.7% versus 23.1% last year. Backlog grew 28%. This business may not have the highest thematic torque, but its profit quality is strong. Aerospace has certification barriers, long customer relationships, aftermarket revenue, and more stable high margins. Its role is to provide ETN with a quality stabilizer when the electrical business has margin volatility. So ETN is not a single growth asset story. EA provides the strongest growth, but also the biggest margin question. EG makes the electrical platform more complete. Aerospace provides the profit quality base. Boyd raises the thermal management ceiling, but still has to prove returns. This is the biggest difference between ETN and Vertiv. Vertiv is purer and sharper. ETN is broader and steadier, but also more complex. Boyd adds thermal management, but returns are not proven yet. The variable that deserves its own section is Boyd. Boyd is the large acquisition ETN closed in March 2026 at roughly $9.5 billion. It makes thermal components, systems, and ruggedized solutions across end markets, including data centers and aerospace, with more than 5,000 employees. Why does Boyd matter? Because AI data center power density keeps rising. In the past, when people talked about data center power, they often focused on distribution, UPS, power protection, and the path that brings power into the data center. But as rack power keeps increasing, Thermal management moves from a supporting issue to a central question of whether the system can run at all. Cold plates, liquid cooling, and heat exchange are no longer peripheral parts. They become part of whether high-power density data centers can actually be deployed. That is the strategic logic of Boyd. ETN was already strong in the power path. Boyd moves it closer to a full grid-to-chip system story. But a correct strategy is not the same thing as a successful acquisition. In Q1 2026, Boyd contributed $92 million of sales and $24 million of segment operating profit. That proves Boyd is not just a concept asset. It is already in the financial statements. But the costs are also already in the financial statements. The company also disclosed $35 million of Boyd-related transaction costs. Long-term debt increased meaningfully. Net interest expense rose to around $106 million. Intangible assets and future amortization pressure also increased. So Boyd is not a story to verify later. Starting in Q1, it has already changed ETN's revenue, balance sheet, interest burden, and return threshold. Here's my summary of Boyd. Boyd points in the right direction, but the return has not been proven yet. It raises ETN's data center content ceiling, and it also raises the financial proof burden. There are 3 things to watch. First, can Boyd maintain revenue and margin on a full quarter basis? Second, do synergies actually appear, rather than staying only in management language? Third, after added debt, interest, and amortization, does free cash flow per share still improve? If not, Boyd only makes the story bigger. It does not necessarily make shareholders richer. Strong orders must become per share cash. ETN's Q1 free cash flow was $314 million. That does not look especially large on its own. But 1 quarter of cash flow can be distorted by working capital, delivery timing, and project preparation. The better approach is to look at trailing 12 months. By Q4 2025, ETN's trailing 12-month free cash flow was about $3.553 billion, or about $9.08 per share. By Q1 2026, trailing 12-month free cash flow had risen to about $3.776 billion, or about $9.70 per share. What does that tell us? At least through Q1 2026, ETN has not become a case where the income statement looks great, and cash flow suddenly breaks. Cash generation is still improving. But that does not mean there is no future pressure. Several variables will continue to matter. Can EA margins stabilize? When backlog turns into revenue, will it require more inventory, more receivables, more project preparation cash? After Boyd is consolidated, will interest, amortization, and integration costs absorb part of free cash flow? Will share count keep improving? And can free cash flow per share keep rising? So ETN's cash flow position is delicate. Demand is very strong. Rolling cash flow is still improving, but margins in Boyd make the next phase of verification stricter. The real question is not whether orders keep rising. It is whether strong orders keep becoming high-quality free cash flow per share. ETN is a power path investment, not pure theme leverage. ETN is not selling electricity itself. It sells the equipment, systems, engineering capability, and now thermal management capability inside the power path. So it is not the same investment as a generation asset. And it should not be compared only by asking which stock is the purest AI power name. A more useful question is this. If you had $1 incremental dollar to invest, do you want the cash flow leverage of power supply? Or do you want the equipment path behind data centers, grid upgrades, and electrification? If you want the second path, ETN is more relevant. The difference between ETN and Vertiv is purity versus breadth. Vertiv is a high-purity data center critical infrastructure company. Growth and margin expansion are more direct, but valuation tolerance is also lower. ETN is an electrical platform company with strong growth and a wider base, but its profit quality still needs to be verified. So we should not give ETN a Vertiv-style pure theme valuation just because it also benefits from AI data centers. And we should not push it back to an ordinary industrial valuation just because it is less pure. ETN sits in the middle. It has more electrical platform re-rating potential than a traditional industrial. It has a steadier base than a high-purity data center equipment stock, but less direct upside torque. What the current price is buying, ETN is not a low expectation stock. Based on the recent market snapshot, ETN traded around $391, with a market cap around $152.3 billion and a trailing PE around 38 times. That is not the price of an ordinary industrial cycle stock. It tells us the market is already buying a combined outcome. The electrical platform identity keeps moving up. Data center orders convert into revenue and profit. Aerospace continues to provide a high-quality profit base. Boyd does not fail, and ideally increases data center content value. Free cash flow per share keeps improving. So the most important meaning of ETN's current price is not simply expensive or cheap. It is buying a high-quality execution story. Over the next 4 quarters, I would watch 4 things. First, Electrical America's margin. Strong EA orders are no longer the question. Data center orders up 240%, and backlog up 44% are already powerful. The real question is whether margin can hold. If EA keeps growing strongly but margin stays below historical highs, then this growth quality should be discounted. Second, backlog to operating cash conversion. Backlog is visibility, not cash. If strong orders come with more inventory, more receivables, more project preparation, and longer delivery cycles, cash conversion will slow. Third, Boyd's full quarter performance. Q1 only included a partial consolidation. The next step is full quarter revenue, margin, synergies, interest, and amortization. Whether Boyd becomes a high-return chain completion asset rather than a financial burden after a high-price acquisition is one of ETN's most important variables. Fourth, free cash flow per share. A larger company is not the conclusion. Stronger orders are not the conclusion. A completed acquisition is not the conclusion. Common shareholders ultimately care about whether free cash flow per share keeps improving. If all four move in the right direction, ETN's high-quality electrical platform story becomes more credible. If two of them weaken at the same time, especially EA margin and Boyd capital cost, the valuation language has to cool down. Final takeaway. The power path is being re-rated. ETN is an important company in the AI power series because it moves us from the power supply side to the equipment and systems side. It is not about where electricity comes from. It is about how electricity enters data centers, factories, and mission-critical equipment. That is its most important position. Its opportunity is not simply strong data center orders. The opportunity is that the AI power cycle is making the power path itself more scarce and more important. ETN has a chance to move from a traditional electrical equipment company into an AI power equipment platform. Its risk is not lack of demand. The risk is that high orders may be diluted by margin pressure, working capital, interest, and the capital cost of Boyd. Its valuation ultimately has to be proven by Electrical America's margin, Electrical Global visibility, aerospace stability, Boyd's net contribution, and continued improvement in free cash flow per share. So the core judgment can be compressed into two sentences. AI power is not only re-rating the supply side, it is also re-rating how electricity gets into the data center. ETN's opportunity is electrical platform re-rating. ETN's test is whether strong orders can pass through margins, working capital, capital spending, and acquisition costs, and still leave behind higher quality per share cash. If, over the next few quarters, EA margin stabilizes, backlog keeps converting into operating cash flow, aerospace remains steady, Boyd contributes without damaging capital discipline, and free cash flow per share keeps improving, ETN can remain one of the most important equipment-side examples in the AI power series. If data center orders remain strong but margins, cash conversion, and Boyd returns fail to follow, then the company may still be excellent, but the stock's valuation language should stop moving higher. That is episode 4 of the AI power series. If you want to keep exploring the new industrial opportunities that may appear behind AI capex, please like and subscribe. I'll see you in the next episode.